1711, the South Sea Company was established as a British joint stock company, and in no time, this company became a juggernaut with monopoly on trades with South America. The British government also allowed this company assume a large portion of the nation's debt in exchange for issuing stock, giving the enterprise an air of stability and legitimacy. At the time, this exclusive trading right attracted several investors across all walks of life, all eager to buy shares of the company. And on cue, the stock price climbed rapidly, fueled by the promise of easy riches and unprecedented wealth. Among the many who were drawn to this seemingly unstoppable wave of prosperity was one of history's most brilliant minds, Sir Isaac Newton. Newton, known for revolutionizing science and mathematics, was no stranger to careful observation and calculated decisions. And at first, his approach to the South Sea Company reflected this. Early in the speculative rush, Newton bought shares, confident in the company's potential. As the stock price steadily climbed, his instincts proved correct. He cashed out at the right moment, pocketing a substantial profit. For most people, this would have been the end of the story, a smart investment, followed by a timely exit. But for Newton, the story was just beginning. As he watched the stock price continue its meteoric rise, he couldn't ignore the growing sense that he had left money on the table. Everywhere he turned, people were talking about their newfound wealth from South Sea shares. His acquaintances were growing richer by the day. The temptation proved irresistible, despite his earlier caution. Newton reinvested heavily, throwing not only his profits but also borrowed money into the frenzy. Fueled by unbridled speculation, the stock price was no longer tied to the company's actual earning potential, but instead to the fervor of investors convinced they could ride the wave of perpetual growth. The frenzy reached absurd levels as stories of overnight fortunes spread like wildfire. This encouraged even more people to pour their savings into the company. Rationality gave way to herd mentality, and caution was abandoned for greed. Newton, despite his unmatched intellect, was swept up in this mania. His reinvestment turned him from an early winner into a vulnerable participant in the bubble. And inevitably, the bubble burst. As the frenzy peaked and doubt began to creep in, the South Sea Company's stock price tumbled. Rumors of mismanagement and fraud surfaced, and panic replaced euphoria. Investors scrambled to sell their shares, but the market had already collapsed. Fortunes evaporated overnight, and the financial devastation spread across the country. And among the countless victims was Newton, who'd also lost everything. Newton's financial misfortune didn't just dent his wealth, it left a lasting impression on his view of human behavior. Looking back on the experience, he remarked, "I can calculate the motions of the heavenly bodies, but not the madness of crowds." You're probably thinking, how could a genius like Isaac Newton, the guy who figured out how the universe works, lose money in the market? Well, his story isn't just about the risks of trading and investment. It's a powerful reminder that even the smartest people can fall victim to the same psychological traps that trip up most traders. Newton wasn't stupid. He understood physics and astronomy better than anyone, but he couldn't escape the pull of greed, the fear of missing out, and the herd mentality that swept the market. He let his emotions take over, and that's where he made his biggest mistakes. We've all been there. We get excited. We chase quick wins, and before we know it, we're off track, trading on impulse instead of our well-thought-out trading plan. But the good news is we can learn from Newton's mistakes. When you understand the psychology behind trading, the emotions, the biases, the temptations, you can develop the discipline to stick to your trading plan, even when the market goes crazy. This video will help you uncover those psychological traps that often make you abandon your trading plan. You'll learn how to master the habits that will help you stick to your trading plan, no matter what the market throws at you. Habit number 1. Identify herd mentality. Imagine the buzz surrounding the new meme coin by President Donald Trump. Social media is now ablaze with posts from self-proclaimed traders claiming they've doubled, tripled, or even quadrupled their investments in just a few days. Influencers are hyping it up. TikTok videos are flooded with hashtag #TrumpCoinGins, and even your coworker who's never traded before is suddenly bragging about his profits. It's easy to get caught up in the excitement because everyone else seems to be making money. So the logical conclusion must be, I need to get in now before I miss out. This is herd mentality at work. This is when decisions are driven by the collective emotions of the crowd rather than rational analysis. The problem is market frenzies are often not based on the fundamentals of the asset. And in the case of the Trump coin, no one's talking about its actual value or utility. Instead, the hype is fueled by speculation and the fear of missing out. Much like the South Sea bubble, where investors flock to the stock without understanding the company's actual earnings potential, the price of the Trump coin skyrockets as more people pile in. But eventually, reality catches up. When the hype fades, the bubble bursts, and those who bought in at the peak are left holding an asset worth a fraction of what they paid. As a trader with a solid trading plan, it's crucial to step back and ask yourself, am I buying this because it's a sound investment or because everyone else is? Just because everyone else is jumping on the bandwagon doesn't mean it's the right move for you. You need to build the habit of constantly separating the hype from the reality and focus on the fundamentals of the market. Think back to Isaac Newton's story. He initially cashed out of the South Sea Company at the right time, walking away with a profit. But when he saw others making even more money, he reinvested, driven by the regret of not staying in longer. That emotional decision not only made the genius deviate from his trading plan, but it also wiped out a huge chunk of his wealth. The market will always present new opportunities. The traders who succeed are the ones that can spot herd mentality. And if you also cultivate this habit, you will be able to stick to your trading plan no matter how loud the crowd gets. Habit 2. Protect yourself, always. Maybe this video is reaching you when you've already decided to fall for the Trump coin hype. Maybe you've seen the social media buzz, watched the price shoot up, and you finally decided to jump in. Maybe you're even telling yourself, this is it. This is my shot to double or triple my money. Or maybe you've done your analysis and your trading plan is screaming at you to participate in the frenzy. That's all well and good. But this is the exact time that the habit of risk management becomes your lifeline. Even if you're riding high on speculation or otherwise, you've got to protect yourself because things can take a turn faster than you think. Without the habit of managing your risk, you're walking into the market blind, hoping for the best. But hope isn't a strategy. So let's break down how cultivating the habit of risk management could save your trading account from total disaster. 1. Define your risk. Imagine you have $10,000 in your trading account and you decide to put some of it into Trump coin. Instead of going all in and risking everything, you decide to follow the golden rule of risk management. Never risk more than a set percentage of your total account per trade. For many traders, this is typically 1 to 2%. So, for a $10,000 account, you set your risk at 2%, which means you're willing to lose no more than $200 on this bet. This risk is predefined before you even hit the buy button. Why is this important? It's important because without setting this limit, it's far too easy to overexpose yourself, especially when emotions are running high. If you dump half your account, or worse, all of it, into one speculative trade, a sudden market reversal could wipe you out completely. And when your risk is high, and the market turns, you get more emotional, and you abandon your trading plan. 2. Use stop losses. Now let's take it a step further. After buying Trump coin, you need to set a stop loss, a predefined price level where your trade will automatically close if the market moves against you. For example, you buy Trump coin at $50 per coin. Based on your analysis, you decide that if the price drops to $45, the coin isn't worth holding anymore, so you set your stop loss at $45. If the price falls to $45, your trade closes automatically, limiting your loss to $200, or 2% of your account. By using a stop loss, You don't have to sit glued to your screen, anxiously watching the market. Stop loss removes the emotional decision-making from the equation and ensures that you're sticking to your predefined risk level and trading plan. Trading without risk management is like driving a car at high speed without wearing a seatbelt. Everything feels fine when the road is smooth, and you might even convince yourself that nothing will go wrong. But the moment you hit a bump or take a sharp turn, the lack of a safety measure can lead to catastrophic consequences. Habit number 3. Avoid overtrading. Let's imagine you're at an all-you-can-eat buffet. You walk in, and the sheer variety of food overwhelms you. Salads, pastas, desserts, fried chicken, sushi, everything you could possibly want. You're tempted to pile your plate high with everything you see because, hey, it's all there for the taking, right? But if you try to eat everything, you're going to end up overstuffed, uncomfortable, and probably regret your choices. The market is like that buffet, full of opportunities, stocks, Forex pairs, cryptocurrencies, indices, and commodities. It's tempting to dive into every trade you come across, thinking, why not grab as many chances as I can? But just like at the buffet, trying to take on too much will leave you overwhelmed, overexposed, and full of regret. It might start with excitement. This setup looks good, but then it quickly spirals into impulsiveness. Before you know it, you're entering trades that don't align with your strategy and trading plan. You're taking positions in markets you don't fully understand. You're increasing your trade frequency just to feel busy or productive. The result? You burn through your energy, your mental clarity, and worst of all, your trading account. Instead of focusing on a few solid trades with a clear risk-to-reward plan, you spread yourself too thin, make costly mistakes, and end up tossing your trading plan out the window. To avoid becoming a trader who takes on too much, start by sticking to a clear plan. Know exactly what setups you're looking for and skip any trade that doesn't fit your criteria. Set limits on how many trades you'll take each day, week, or month, as this helps prevent impulsive decisions. Patience is crucial, and often, the smartest trade is the one you don't take. So, the next time you're tempted to chase every opportunity, remember, your account and your stomach will thank you for keeping it simple and strategic. In trading, less really is more, and that's why I stick to just one pair and take most of my trades on the daily time frame. Habit number 4. Maintain a trading journal. What is a trading plan without a trading journal? Imagine trying to improve at anything, sports, cooking, or even public speaking, without keeping track of what works and what doesn't. It would be nearly impossible to measure progress or pinpoint mistakes. Trading is no different. A trading journal isn't just a record of your trades, it's your personal roadmap to becoming a better trader. Many traders focus solely on the charts and ignore the most critical element of their growth, learning from their own experiences. Without a trading journal, you're essentially operating blind, repeating the same mistakes, and wondering why your results don't improve. A trading journal is like a mirror. It reflects your strengths, weaknesses, and tendencies. It's not just about tracking wins and losses. It's about understanding why you made certain decisions and how those decisions impacted your outcomes. If you are wondering what a good trading journal should include, here are a few important ones. Entry and exit points. The asset you traded. Is it Euro USD, S&P 500, or Bitcoin? Position size. Risk to reward ratio. Why you took the trade. What was your strategy? If you would like to be a bit more detailed, you can include other things like specific technical or fundamental signals that influenced your decision. Your emotions during the trade. Did fear or greed play a role? Did you feel confident, hesitant, or impulsive? Were you tempted to deviate from your plan? It should also contain the outcomes of your trades. Did the trade hit your target or stop loss? If you closed it early, why? What was the profit or loss? Finally, you should make notes of lessons from the trade. What worked and why? What didn't work? How can you avoid repeating it? Are there patterns in your behavior that need addressing? A trading plan without a journal is like having a recipe, but never tasting the food you cooked. The habit of keeping a trading journal and writing down every decision keeps you disciplined and will help curb impulsive choices. It also lets you track your progress, reminding you of how far you've come and everything you've learned along the way. It's a simple but powerful habit for self-reflection and growth, helping you trade with more consistency and success. Habit 5. Adopt long-term thinking. Deviating from your trading plan is thinking short-term. Successful traders don't get caught up in the highs and lows of individual trades. They don't obsess over every red or green candlestick, or let one loss, or even a string of losses, define their journey. What they do have is a clear vision of their long-term goals, and that vision keeps them grounded, disciplined, and focused on their trading plans. Short-term thinking, on the other hand, is one of the easiest ways to deviate from your trading plan. It's tempting to think, if I just make this one big trade, I can hit my monthly target. Or, if I chase this trend, I'll recover my losses faster. But these thoughts are traps. Imagine placing a risky trade that pays off big. The excitement is undeniable, and it might even make you feel like you've cracked the code to trading success. But the problem is that win doesn't mean you've built a reliable strategy or a repeatable trading plan. Short-term wins can create a false sense of confidence, tempting you to take bigger risks. But when the inevitable loss comes, it hits harder because your expectations were built on unsustainable results. The habit of thinking long-term shifts your focus away from individual trades to developing a strategy that delivers consistent results over weeks, months, and years. Losses, which are inevitable for every trader, are seen by short-term thinkers as failures, leading them to react emotionally, chasing losses, or taking on more risk to recover. It's like a road trip. Hitting a pothole doesn't mean you abandon the journey or speed recklessly to make up for lost time. The logical thing is to adjust, stay steady, and keep heading toward your destination. The amazing thing about this approach is that it also allows traders to harness the power of compounding. Steady, small gains can build up over time, much like planting seeds and watching them grow. For instance, if you start trading with a $10,000 account and you're able to gain just 2% monthly growth, this may not feel like much at first, but after a year, it grows to $12,682. Give it 5 years, and that same account would have grown to $26,532, all without taking unnecessary risks or chasing shortcuts. Successfully sticking to your trading isn't about chasing every opportunity or winning every trade. It's about consistency, discipline, and a commitment to your long-term vision. So, pace yourself, follow your trading plan religiously, and you'll outlast the chaos. There are some harsh truths about the psychology of trading that a handful of people only discover after enduring years of painful losses in the market. But you can learn these truths. I wish I had known when I started trading, in just 10 minutes by watching this video. Please don't forget to like, comment, and share this video with others so they can improve their trading. If you're new here, it would be nice to subscribe to the channel for more content like this. Thanks for watching.